Good day to you, sir. Today, we are here to present Review 3 for our Financial Markets and Institutions project. The title for our project is Stock Listing Mechanism in India and the Role of Regulatory Agencies. Now, going public is a monumental decision for any company. It forever changes how a company goes about doing business. A public company has access to more and often deeper sources of capital than a private company. The actual process of going public can be time consuming and presents certain unique challenges that a company should be prepared to undertake. Indian primary capital markets have been influential in providing opportunities to Indian businesses to expand, modernize, and diversify through fundraising in lieu of issuing equity shares to the public. For modern companies, the ability to access means of finance through initial public offerings has propelled their growth. Indian primary capital markets have grown consistently over the years. The financial years 2017 and 2018 saw heightened activity in the primary market, both in terms of number of issuances and in the amount of capital raised. According to public sources, 2018 Indian companies raised US dollars 11.6 billion across 38 IPOs, making it the best year in terms of IPO proceeds in a single fiscal year for India. The Indian IPO market is expected to remain robust and attractive due to a resilient and growing economy, strong domestic liquidity, and robust corporate earnings. Steady investor confidence and rising domestic participation in the equity markets are resulting into a healthy IPO pipeline across sectors. On a parallel note, the importance of corporate governance in both developed and emerging economies cannot be denied. In India, the securities regulator SEBI, the Securities Exchange Board of India, was the first regulator of corporate governance through Clause 49 of the Listing Agreement. In late 2015, the Securities and Exchange Board of India issued the SEBI Listing Obligations and Disclosure Requirements, the LODR, which made comprehensive changes to the regulation of corporate governance in listed companies. It has not only given the listing agreement statutory status, it has made significant structural and substantive changes in corporate governance regulation. What we are going to discuss is about the capital market, initial public offerings, role of regulators, underpricing of IPOs in stock exchanges, their short term performances, and so on. We also discuss a few certain IPOs and their journey to be publicly listed. There are studies that talk about IPO frauds investigated in different accounting dimensions to show how the unscrupulous promoters defraud small investors through IPOs, mostly assisted by financial institutions, aided by conniving merchant bankers and subsequent failure of regulatory authorities to enforce the law. The promoters manipulate cost and income projections through trickery, defrauding the small investors so much so that the investors lose out in the spiral of booms and busts of the primary market vagaries. In a way, promoters literally got away with financial murder, some can say, proving once again that white collar crimes do pay. To everybody's surprise, the authorities who took incredible pains in articulating rules and regulations, these laws, in ensuring playing fair at the market, showed either utter apathy when any wrongdoing was done by the players or was even caught red handed or tried to save wrongdoers' faces going beyond anyone's imaginations. Our study and our project highlights the importance of enforcement of capital market laws with regards to articulation. We talk about the various regulators and their roles and functions in stock listing in the Indian capital market, such as the Ministry of Finance, the Reserve Bank of India, the Securities and Exchange Board of India, SEBI, is the apex body governing the Indian stock exchanges. It has majorly three primary functions, namely protective functions, development functions, and regulatory functions. SEBI plays a really important role that helps people, corporate organizations, or high net worth individuals to participate in the Indian stock market of both the domestic or foreign financial intermediaries, which are governed by the regulations framed by SEBI. Additionally, the foreign portfolio investors can participate in the Indian stock market after registering with an authorized depository participant. This is all regulated by SEBI itself. Now, in India, we have two big stock exchanges, namely the National Stock Exchange (NSE) and the Bombay Stock Exchange (BSE). In simple terms, a stock market or a stock exchange is a platform where people buy and sell stocks, prices of which are set according to the prevalent demand and supply situation. It is very similar to a marketplace where traders buy and sell goods, quoting prices on the basis of the demand for the good and the availability or supply of it. Now, as we move on, we like to discuss some functions of the capital market. It obviously helps in the growth of the economy. The capital market reflects the condition of the economy and also accelerates the economic growth. It allocates the resources from the people who have surplus capital to who require capital. By this, we can conclude that capital markets help in the growth of the economy as well as the trade of both public and private sectors. This leads to a balanced economic growth in the country. Second, it encourages people to save. Development of the capital markets has helped the banking institutions to provide facilities and provisions to encourage people to save more. People might have just invested in land or gold in the non existence of a capital market. Moving on, we have a third major reason that it stabilizes stock prices. Capital markets have reduced speculation activities and also provided capital to the borrowers at the lowest interest rate as possible. This helped keeping away the prices of stocks from fluctuating. Now, from functions, we discuss role of capital markets. They ensure the proper allocation of funds. It is an important platform for allocating idle savings from the people to productive channels of an economy. It puts the idle funds in proper investment. Then, it also helps in formation of capital, as these markets help in formation of capital by adding capital to the existing capital in the economy. This helps in the expansion of the economy. It provides a platform for investment. It accelerates economic development, as we have just discussed. And it also provides service like medium and long term loans, consultancy services, export finance, etc. Now, as we begin our way to discuss initial public offerings, IPOs, that is the major and main focus of our project. Now, the primary market in India gained importance and popularity amongst corporates in the era of liberalization, commencing from the year 1992. Before this, the CCI, the controller of capital issues, was the regulatory authority that governed primary markets in India. The CCI also had expansive powers to determine the fate of a corporate accessing capital markets, including the power to dictate which corporate should raise capital and the enterprise value of the corporate. Consequently, the prices of the shares to be offered was thus decided by CCI itself. However, the then government of India abolished the CCI and constituted the Securities and Exchange Board of India, SEBI, through an act of parliament. SEBI came out to be an autonomous statutory authority to regulate the capital markets. Then, SEBI introduced the Disclosure of Investor Protection Guidelines, the DIP guidelines, which were subsequently amended and updated over the years. Now, as we move on, we try to see that in 2009 as well, there were issue of capital and disclosure requirements regulations by SEBI, which were later amended and updated recently in 2018. These regulations, with along with the Companies Act 2013, regulate IPOs in India. Now, for a company, there can be many reasons for going public. An IPO, initial public offering, is an essential means of raising finance for companies to meet business needs. It is a complex transaction which marks a new milestone in the history of a company. A listed company in India, that is, a company which has its securities listed on a recognized stock exchange, is required to adhere to strict norms of corporate governance and is regulated by SEBI and Indian stock exchanges. This enhances the credibility of the company and makes it easier to access funds in the future from both local and international investors and institutions. Now, from being a private company, publicly listed helps the company to get regulated with key corporate and financial information available in the public domain, and also opens them to access funds from all types of people: small investors, high net worth investors, and other organizations as well. Now, another important reason for a company to go public is to ensure that the private equity investors who have invested into the company in its beginning stages, the nascent stages, also get an opportunity to exit with an attractive valuation. Angel investors and private equity investors are significant contributors to the growth of the company. And to ensure that such private equity investors continue to remain enthusiastic towards capital investments, it is important that they can secure a viable exit. This means that they should have an option to choose to either stay or leave. Now, the current scenario in India is skewed towards private equity backed IPOs, which are being priced attractively with the aim of unlocking and creating shareholder value. These reasons, coupled with brighter earnings, outlook for Indian corporates, and a stable secondary market, they have been inspiring Indian companies to embark on this value journey. Now, as we move on, we discuss about the IPO process, that is, the steps, the timing, the various parties involved, as well as the market practice. Now, an IPO results in the transformation of a private company to a regulated public company with far reaching consequences in terms of liability. Given the intense level of regulatory scrutiny, it is important that a company be IPO ready. The business and cultural fabric of a company can completely be overhauled during this process. The entire process can typically be divided into two parts. Now, the key initiatives towards the DRHP filing, that is the draft red herring prospectus, and the second, the regulatory procedures until listing and marketing activities. Now, an IPO in India requires the filing of a draft offer document with SEBI, which is scrutinized by the regulator, while comments from the public are also sought. The updated offer document after incorporation of SEBI and public comments is filed with the registrar of companies. Thereafter, the IPO is opened for subscription to the public. The final prospectus is filed with the registrar of companies after closure of the IPO subscription, but prior to the allotment of securities. Now, when we discuss about the key initiatives towards the draft red herring prospectus, we can talk about the offer document preparation and the due diligence which should stand the scrutiny of SEBI. During this process, there are book running lead managers which help the company to do so. They help them prepare financial statements as per the ICDR regulations. They help them adhere to corporate governance norms. Finalization of the business model and plan is done. They obtain consents and approvals from all parties involved, maybe the angel investors, the private equity backed investors, the board members, the workers, the employees, the major executives of the company. Appointment of intermediaries is done. Discussion is held with shareholders for termination of special rights upon completion of IPO. Then there is also the regulatory procedures that need to happen until listing happens, and along with the marketing activities. Now, once the DRHP is filed, two parallel procedures are conducted simultaneously in close proximity to each other. That is, the execution team of the BRLMs, the lead managers, and the legal counsel work closely with SEBI and the stock exchanges to obtain regulatory clearance for the IPO. Second, the marketing teams get to work. They're also known as the equity capital market team. They go on road shows to market the IPO to potential investors. It should be noted that such marketing activity needs to be conducted in adherence to specified laws. Violation of such laws can have serious liability issues. Like today, we are going to talk further about certain scams and frauds that have happened in IPOs. Marketing is one of the important processes where investors can be fooled. Now, once all this is done, the new investors can come into the company and invest during listing. Now, to summarize, the key parties involved in an IPO are the book running lead managers, syndicate members, and underwriters, legal counsels, auditors, escrow bankers, the registrar, the self certified syndicate banks registered with SEBI, the monetary agency, also SEBI and the stock exchange like NSE or PSE. There can be seen that there are certain unique regulations in India. A unique feature of the Indian IP regulations is the requirement of minimum promoter contribution. Though this has been recently changed, it is still followed by most companies. This is the rule says that the promoters of a company that is going public have to necessarily lock in 20% of their post IPO shareholding for a period of 3 years after listing has been done. SEBI and the prospective investor community still view the promoters as key figures or the essential link between the company and a continued growth for all investors. In offshore jurisdictions, this requirement to lock in promoter shares post IPO is not that necessary. As businesses in India are becoming increasingly professionally managed, it may be time to consider to do away with this requirement to have promoter shares locked in. However, this should be a gradual process, like that is actually happening, so that investor protection is not compromised. Now, we'll move on and talk about the performance of IPOs. It has been generally observed that in the Indian capital market, IPOs have been underpriced. My team member Raunak Banerjee will talk about this.
Hello, my name is Raunak Banerjee, 18BW0293, and I want to talk a bit about underpricing of IPOs. So, generally speaking, underpricing of IPO basically means listing the IPO below its market value. Now, generally, underpricing IPOs is a tactic that generally works out due to the reason it attracts a lot of retail investors, and by the end of the day, the companies gain up on the money that they are underpriced. So I'd like to talk about a few specific reasons due to which underpricing of IPO is done. The first one I want to talk about is winner's curse. Now, what I basically mean is that broadly speaking, there are two kinds of investors out there: the institutional investor and the common man, the retail investor. Now, if company gives out its IPO, and let's say it's not a very known company, it's a small company, a local company, about which a lot of people don't know about it. Then, if the price is really high, the chances of it attracting a retail investor would be less. So, if they underprice the IPO, that would mean a lot of retail investors would be attracted towards them. So, this is something why underpricing of IPO is basically done. Now, the next thing I want to talk about is market feedback. As I said, underpricing the IPOs would mean a lot of retail investors investing in them, and that would mean a lot of competition would be created in the market. So, if an IPO is so, if I can buy the share of a company at a less rate, then that would mean a lot of people would be interested in that, and a lot of people would start buying the stocks. That would slowly, gradually increase the value of the share. Next thing is I want to talk about is bandwagon. What I mean about this is that, as I said, more retail investors in the market means more competition, and that also means that a company creates kind of a momentum with respect to its IPO, and that would mean that a lot of retail investors following each other, me getting to know from my fellow colleagues that there's this so and so company whose shares are being sold at a lesser rate, and I'd also be tempted to buy its shares. Now, the next thing I want to talk about is monopsony power. So, the monopsony power exists within the banking, investment banks. So, I'll give a small example to explain. Let's assume I am a businessman in India, and I'm the CEO of a company, and I've been based in the United States for a couple of years, and I want to go public in the US. So generally, when I want to go public, I'd probably consult a big investment bank to suggest me what are the things I need to do to go public, what should be my initial offering. So a lot of investment banks you know tend to suggest to companies to underprice their IPOs, and a lot of companies agree to this because of the underwriting process. Now, basically, the underwriting process is basically an insurance. What it means, let's assume I wanted initially as the CEO of my company to give out the shares at $15 each, and let's say my prediction was I'd gain around, like, I'd raise $15,000 worth of capital after the first year. And let's say the investment bank said, don't set your price at $15, set it at $12. That would mean I earned $12,000. Let's say I earned 12,000 and the price doesn't go up somehow, and as I was talking about the competition among retail investors, it doesn't happen, and instead of my original prediction of 15,000, I earn only 12,000. So there's a loss of 3,000, and the underwriting process means basically I'm insured for the $3,000. The investment bank is supposed to pay me that. So the underwriting process is basically insurance policy. The other thing I want to talk about is about dispersion. Now, underpricing an IPO would ensure, especially for the smaller companies, to have a broad band of investors, different kinds of investors from different communities. Like, if the IPO, if like the cost of the share is really high, that would mean only institutional investors being part of your company. The retail investors won't be able to invest in your company, and many companies don't want only institutional investors to invest in them, because that would mean, let's say, basically the institutional investors running the company, and a lot of CEOs don't want that to happen. So we've seen from the statistical analysis that we've carried out that recently there's been rise in underpricing of IPOs in India, and most of the companies, we've seen that 23% of the companies who've gone to who've taken the monopsony uh, rate, follow the monopsony route, that is basically follow the underwriting process also, tend to have more favorable results in the future.
So I want to talk about the public issue process in India a bit. And since 1992, before 1992, the Indian government controlled the pricing of most of the equity issues, and the CCI priced the issue of equity capital under a predetermined formula. So since 1992, the SEBI regulates the new issue process. So on a like nowadays, an investment banker who is the lead manager manages such public issues, so he can enlist the support of other investment bankers. He's responsible for all the key decisions and administration of the issue process, and is required to adhere to the norms as specified by SEBI. And now, so with the introduction of the book building process and the scrapping the concept of par value for shares, the pricing process has become kind of more open. It's now possible to follow the fixed price route or the book building route for an issue. So in case of the book building process, which I believe is better, the price band is suggested. So a lot of investors decide on a set of values on which they settle on their IPO. And the book building process is completely automated. It's an online system using the system of the stock exchanges. And so I think just the book building process is really better than the fixed price method. Okay. I've been speaking about the various reasons for IPOs being underpriced, and I want to just say that this I found out that there is very little evidence between underpricing and IPOs that use a book building method are different or vary a lot from fixed pricing method. However, I mean, it's still kind of consistent with the premise that the book building method reduces information asymmetry, because a lot of investment banks, a lot of people are working together on determining the price of the IPO. Hence, the chances of error reduces in this case. And but it doesn't always necessarily matter that it results in a lower level of underpricing. And I want to also say that the Indian IPO market is not as developed as a few of the ones in the Western world. The reason being, the number of firms going public in India has increased a lot, but we are like really far away from the standard of other developed countries like Japan or USA, to be honest. And a lot of people still think that IPOs are considered, they consider them as a speculative opportunity rather than somewhere where they can really invest. Like a lot of Indian people still have that they'll probably buy land or real estate rather than invest on the market. So that is a huge problem in India, and that's why we are struggling behind a lot of foreign markets. And the evolution of placing procedure from fixed price offerings to book buildings has not really improved the efficiency of the Indian IPO market. So it's a pity that in India no transparency characterizes intermediaries activism even after the listing. Like even after so many issues like the Harshad Parekh case and so many things, like there are still scams going on, insider informations being like people are obtaining information from the inside. Like even after we've got a digitalized system, through Demat account where you can buy stocks, like information still leaking out. So that's a huge problem, I'd say, like on the level of corruption. And I think that SEBI should arrange as soon as possible a list of detailed on information to be filed and published, especially by the intermediaries when during the listing procedure. And like one more reasons I'd like to say is that a lot of big tech companies in India still are not listed on the market due to the fact a lot of people are not investing on the market. Like if you look at I think Ola, Paytm, none of them are listed on the market, so they still prefer angel investors and venture capitalists to finance them. So I'd say underpricing in India has been has been happening, but since the book building concept in India isn't that prevalent, so the tactics used by like the underpricing tactics isn't done properly. So a lot of small companies tend to underprice their IPOs and really fold up. So that's something I feel a lot of Indian companies can work on, working on the book building process.
Now I'll be talking a little bit about IPO frauds and scams. Now, our motivation behind studying about IPO frauds was that there are literally really poor number of papers that talk about such cases, that discuss how various aspects of the primary capital market has been defrauded. The literature explaining the ways how the unscrupulous issuers cheat the gullible investors in the capital market induced us to evince special interest to go in for this study to supplement the growing literature on IPO scams in India. We highlight the already investigated factors and parameters through which dishonest corporate issuers have tried to defraud small investors in the primary market, working in unison with the financial institutions and banks, merchant bankers, as well as, needless to say, regulatory authorities. Now, we all know that IPOs channelize long term savings into long term investments by mobilizing household savings into corporate investments. It fulfills the transfer function of current purchasing power in future and thus enables companies to raise funds to finance their investments in real assets. The economy's productivity obviously increases, leading to more employment, increasing aggregate consumption, and thus growth and development. It also provides relief to the banking system by matching long term investments with long term capital and broader ownership of productive assets to the small savers as well. Now, it enables small investors to benefit from economic growth and wealth distribution and indirectly encouraging thrift culture within it, which is critical for industrialization in an economy like India. We are still in a developing phase. We haven't fully developed. So our capital markets really need to pick up the pace and move farther and beyond. Now, it has been observed that industrial growth through channelization of domestic savings into productive investments is only possible when capital market is free from all imperfections. That is, capital market frauds, and the investors repose their confidence into the capital market and keep on investing to boost economic growth. But to everybody's horror, unlike other international capital markets, the Indian capital market is severely plagued by frauds and ingenuity, which knows no bounds. This might not be a sweeping statement if vouched by the following India's biggest capital market scams, namely the Bhai Raju Ramaliga Raju scam, which was worth rupees 8,000 crores, the Harshad Mehta case, beyond 4,000 crore rupees, the Ketan Parekh case, approximately 1,500 crores, the C.R. Bansali, 1,200 crores, the Cobbler scam, in which the Daya of Dawood shows, Rafiq Tejani of Metro Shoes, and the Kishore Signapur of Milano shows availed loans of crores of rupees on behalf of fictitious cooperative leather societies which did not exist. The Dinesh Dalmia, around 600 crores. And obviously, we all know the story of Vijay Mallya. Now, my team member will talk about certain case studies we did on IPOs, like the recent IRCTC IPO, the SBI Cards and Payment Services IPO, and a small case study on DMart, a small business that was successful as an IPO.
I'm Avanthika and my registration number is 18BC2105. Now I would like to talk about one of the recent IPO case studies on Indian Railway Catering and Tourism Corporation Limited. As a central public sector enterprise wholly owned by the Government of India and under the administrative control of Ministry of Railways, currently IRCTC operates in 4 business segments, namely internet banking, catering, packaged drinking water under the Rail Need brand, and travel and tourism. The objectives of issue are to carry out the disinvestment of 20,160,000 equity shares by the selling shareholder constituting 12.60% of IRCT's paid up equity exchanges. And the second objective of issue is that IRCTC will not receive any proceeds from the offer and all proceeds shall go to the selling shareholder. The business strategy is diversifying and offering new services to the passengers of Indian Railways and others. The key concerns are it is exposed to risk associated with online security of his customers' personal information, and credit card fraud. If IRCT is not successful in managing growth, its profitability may decrease and result in adverse impact on the business results of operations and financial conditions. Business and activities is related business and activities is regulated by the Competition Act. Any adverse application or interpretation of the Competition Act could in turn adversely affect the business. Fluctuation in the exchange rate between the Indian rupee and foreign currencies may have an adverse effect on the value of equity shares, independent of its operating results.
Good day to you, sir. My name is Raghav Behal, registration number 17 BCE 0633.
Good afternoon, sir. My name is Raunak Banerjee. My registration number is 18PEE0293.
And my name is Avanthika and my registration number is 18BCE2105.
We are here to present our review 3 for financial markets and institutions. Our topic is stock listing, mechanism in India, and the role of regulatory agencies. Sir, as you can see in the screen, this is a report that we have created for our final review. In the video earlier, we have already discussed about the Indian capital market, the various regulators, their roles and functions, then the stock exchanges, the functions and role of the capital markets. Then I had also talked about initial public offerings and how companies go public and what all procedures they need to follow in order to list as a public company. In this meeting we are having for review 3, we are going to talk further about the data and research we have conducted on certain IPO scams and the performance of IPOs in the Indian capital market. To begin with, let me take you to the page where it talks about the IPO frauds and scams. Here you can see that we talked about the Ketan Parekh case, the Bairaju Ramaligu Raju case, the cobbler scam, and now I'll show you some data. As you can see on the screen, we have talked about a company called Paras Rampuria Synthetics Limited. Now, this is a scam that was about a company where the cost and income projection was shown in a way that it fooled investors. It was appraised by ICICI and it had about a rupees 100 crore issue prospectus. It misled and gave insufficient information to the small investors by setting up the objectives of the issue were to set up a continuous polycondensation plant of about 35,000 tons per annum and 78,750 TPA at Silvassa. It had the aim to enhance polyester filament yarn spinning capacity and also establish PFY spinning facility. Now, the cost of the project as appraised by ICICI in 1994 and then reviewed in 1995 is shown in the tables below. As we can see, the means of finance is given in table 2 and table 1 has the cost of project. Due to the challenges in the scenario, the ICICI fooled investors by showing what actual cost was involved and how they were going to achieve it. So as we can see in these tables, the correctness of the ICICI appraisal was disputed on various counts, such as a lower project cost had been appraised. It did not take into consideration the full working capital, as I have just mentioned. Also, since the interest outgo only on the MPBF was considered and not the whole working capital, There was a lower provisioning of projections regarding interest to the extent of the amount of capital in the years 1907 and 98. And furthermore, the capital was increased in 98 and 99, which resulted in the net profit being overstated by almost 22.2 crores. The most alarming aspect of this deliberate lower provision of interest outgo was not its adverse impact on future profits, which was consciously reduced, but it resulted in a tremendous disbelief about smooth future options. So, the way the bank conducted itself in this appraisal was quite alarming and surprising, and led to fooling and defrauding the small investor. Similarly, we have another case of a company called Modern Threads Limited, MTIL. Here, it was proposed to set up a purified terephthalic acid manufacturing project whose cost was evaluated at 1590 crore rupees to be financed by 600 crore equity, and then to be raised through public cum rights issue and long-term loans of rupees 990 crores. However, the figures were fudged here as well, causing a lot of figures to or people to mislead the situation and defraud the small investor. The third company is SVIL, Sri Vishnu Puriya Industries.
SBI Industries now. So the highlights of the SBI were not in the wrong profitability estimates appraised by the IDBI, but the utter lack of resources with the promoters. So if you look at the data, the net loss incurred by the company and firms of the promoters in 3 preceding years was around 24 lakhs. If you look at the sales domestic data, the IDBI data shows 56.63. However, the correct figure is 32. So there's almost a difference in a factor of 24 here. Now, with projections based on such calculations, the investors to the public issue were expected to take an informed decision, where to invest or not in the public issue. So this is considered an adequate disclosure by SEBI for the investors' protection. And the shortfall in resources seem partly to be filled by business associates spearheaded by SR Gujarat, which was to subscribe for about rupees 8 crore to the equity capital. And MOU was concluded with SR Gujarat to supply raw material requirements. And the prospectus also doesn't make it clear who all were promoters. Rather, a list of 10 persons were shown who collectively held around 12% of the total paid-up capital. And the cost of project stated to be reviewed by IDBI in 96 must have taken into account the increase in the cost of the indigenous plant and machinery engineering fees. Otherwise, 11 crores earmarked for contingency in the project cost would have not been there in the prospectus. So, I have found out that some contents in the prospectus which require due attention, where first of all, the profitability statements only for 3 years allowed by SEBI. The cost of HR coils has been taken out at rupees 1700 per ton, which is enormously high. And the basis for the selling price of CR coils in the domestic and export market has been given. And it was, in the end, it was to the horror of everybody that capacity utilization was projected to up to from around 50% to 80%. So that was a huge issue.
So, sir, now as we see, these three companies were able to defraud investors through financial institutions, established institutions, and regulatory agencies, which just did not did not want to observe closely what was actually happening. After the fraud part, we would now like to talk about the performance of Indian IPOs a little bit. Now, worldwide, there have been two major anomalies concerning IPO literature: the listing day underpricing and the post-listing underperformance in the medium to long run. Now, the closing price on the listing day for IPOs has been much higher than the issue price, which is termed as underpricing of IPOs. When the returns of these IPOs are calculated for 1, 3, or 5 years, the market adjusted returns have been significantly negative, and this has been observed in the Indian market over and over again. So our motivation to study this topic was because there is not much literature to support the fact that Indian stock exchanges underprice certain IPOs, and IPO grading is
And
done in a way that
now,
is not understandable to the small investor. So through this, we would
sorry.
move on to talk about the underpricing that has happened for some years now. Raunak will like to talk about that.
Well, as Raghav mentioned, the main issue with IPO underpricing is that the retail investors are the ones who get caught up in it. And the reason being, basically, as I've explained earlier, underpricing is basically done to attract more and more retail investors, because a lot of companies want dispersion in the amount of investors there. But a lot of companies don't want too many institutional investors in their companies. They want a lot of uh, retail investors. So we've done a study by taking 464 IPOs, out of which 365 were book build IPOs. Book build IPOs, I mean that their listing procedures were managed by investment banks, and 99 fixed price IPOs, which are the fixed price IPOs are the ones whose IPOs were fixed by the normal investors. And we've taken the data from 2001 to 2011, and it covers all the data has been taken from NSE website. So we have the statistical analysis that we have done. We've got this equation that you can see: IR equals PI minus PI naught by PI naught. So the IR is the IPO subscribers' initial raw return from security I. PI is the closing price of the IPO, and P naught is the issuer price. And we've calculated the benchmark adjusted underpricing, and from the next thing that we've done in the methodology is that we've also calculated the daily raw return for security I. So the daily raw return for a security I would be PIT minus P minus 1 by PIT minus 1. PIT minus 1 is like the previous price of compared to PI. And we've also done a parametric significance test, and which tests that in testing the long-run performance of IPOs, we've tried to gain some information about the average price behavior of securities during the post-listing period. So the results that we've got is, so the average raw return per percentage, if the opening price is 25.21, the high price has been 51.2. So we can see that there's almost a difference of 25% in the underpricing value. And the results from the table suggest us that when computed using the closing price, both raw and market adjusted returns can be seen. And investors who are lucky enough to sell their allotted shares at the high price on the listing day make a listing day gain which is little over 50%. So they basically are making the gain because the IPO was underpriced initially, and at the end of the day, they are since due to the competition between the retail investors, the price has been increasing. They are selling out their shares, hence they are gaining a lot. So
Sir, here we would like to say that there are many tables which show different type of information from those 464 IPOs that we have studied. You can see the underpricing as well as the post-listing performance of various IPOs through these figures and tables.
Sector-wise information is also been shown in the table. And finally, we've determined that to understand whether there's any, an industry-specific effect in the long-run performance of IPOs, we've divided the samples based on firms and industry groups. And we've seen that most of the big companies that tend to underprice their IPOs, like the big firms, are successful in the long run, and a lot of small companies that underprice their IPOs tend to succumb to pressure, and a lot of companies are actually shut down. So underpricing is a favorable option for a big company, not a small company, generally speaking.
And similarly, we have seen with the frauds and scams where huge companies and organizations, they mislead and fudge the numbers so that the common man cannot understand them, and through marketing they can just awe them into buying their shares. And this is why the post listing performance is also affected, and people are misled through the same. Now, we would like to move on to certain IPO case studies that have recently happened, like the IRCTC SBI card and a small business DMart that was finally a successful IPO. So, we would like to start with Avantika, who will talk about IRCTC first.
I would like to talk about IRCTC, that is Indian Railway Catering and Tourism Corporation Limited. As a central public sector enterprise wholly owned by the Government of India and under the administrative control of Ministry of Railways, currently IRCTC operates in 4 business segments, namely internet ticketing, catering, packaged drinking water under the Rail Neer brand, and travel and tourism. And if we look at the objective of issues, the first objective of issue is to carry out the disinvestment of 20,160,000 equity shares by the selling shareholder constituting 12.60% of IRCT's paid up equity exchanges. IRCTC will not receive any proceeds from the offer, and all proceeds will go to the selling shareholder. And the business strategy that they have used here is diversifying and offering new services to the passengers of Indian Railways and others. And now, when we look at the key concerns, it is that it is exposed to risks associated with online security of its customers' personal information, and credit card frauds. And if IRCT is not successful in managing growth, its profitability may decrease and result in adverse impact on the business and results of operations and financial condition. And one more concern of this is that the business and activities is regulated by the Competition Act. Any adverse application or interpretation of the Competition Act could in turn adversely affect the business. And one of the major and main other concerns is that the fluctuation in the exchange rate between the Indian rupees and foreign currencies may have an adverse effect on the value of the equity shares, independent of its operating results. That's all about the case study of IRCTC. And now Raunak will talk about the SBI.
Well, as we know that SBI cards recently released an IPO when the issue was opened on 2nd March, and like I just would like to highlight some of the strengths that the SBI IPO, SBI cards would have. Like one of the main reasons being SBI is the most thoroughly used bank in India, and that would mean attract a lot of investors towards it. And as far as its business strategy was concerned, it was like the main aim of SBI was to enhance cardholder experience and to optimize risk management processes. But I'd like to highlight some key concerns regarding SBI. First of all, the reason being like a lot of other like private banks are in the market for a long time. For example, Axis Bank, HDFC Bank have been in the market for a long time, and SBI might struggle against them. Now, one of the major problems SBI might face is that it's quite unsuccessful to implement new technologies, for example, blockchain or other web applications. So it's been
And
quite
Raunak,
outdated.
one big concern about SBI, like obviously we all know that it is held by the government of India, and whenever there is a problem when any other bank that has been owned by government, all the weight is put onto SBI. So any
That
like any funds, if any funds or loss which has to be handled by the government is always on the shoulders of SBI. And plus the uh, technological advancement is not as good as other private banks that are already so far and beyond in the game.
Yes,
But
and one more thing I'd like is that SBI is still controlled by its promoters. Like even after the completion of the offer, it will still be controlled by the promoters. And as Raghav, as you said, like it's directly linked to the government. Like seasonal changes tend to happen a lot in government organizations. Like that could be a factor that could potentially slow down its growth versus versus the private players in the coming future. So that could be an issue for SBI.
Yes, that's true. We have also attached the balance sheet for both IRCTC and SBI in our document, as you can see, sir. And here we have talked about a small business which had a success story with its IPO. Now, this company is named DMart, uh, is actually owned by Avenue Supermarts. It was able to raise 1870 crore rupees through an IPO of approximately 6 crore equity shares and face value of 10 rupees via book building route. The objective was to use these proceeds for loan repayments and non convertible debentures to be redeemed and to develop and create progress for the company. Now, we have also mentioned about the book running lead managers like the Kotak Mahindra Capital Corporation Limited, the Axis Capital, HDFC Bank, the various banks that were involved in the bid. This happened from 8th to 10th March in 2017, and the range was between 295 to 299 rupees. We have already mentioned the face value and the number of shares, approximately around 4.5 crores, and it was finally successfully listed public in the public domain on 21st March 2017. Now, if someone asks what could be the reasons behind such an IPO success, is that DMart focuses on providing value retailing and daily low prices to customers. And one of the biggest example worldwide for this type of a business strategy is Costco and Walmart. They have expanded their business on by keeping the customer first. They have a strong supplier and vendor network, and they focus only on food and grocery, unlike other competitors like Reliance Fresh and Future Retail, which have diversified into electrical goods, apparels, and home segments category. So,
And also like to say that I think DMart has a no discount model. So like it's kind of profitable in the long run in retaining customers. And since as Raghav you said, DMart had got really favorable reviews from customers. So a no
yeah,
discount model
since
hasn't really hampered the
like
growth.
this creates loyalty in the future. The company can view the loyalty of the customers, and by giving lower prices, the customers enjoy the loyalty of the organization.
And
So,
one more main reason for their success would be that they selectively expand their stores, like in big cities like Mumbai and Ahmedabad, and they have a strategy for it, and they target densely populated housing areas, and also that the ownership model of all the stores owned by ASL itself are on the rent with a long-term agreement for more than 30 years.
Yeah, that shows that it's gonna be there for the long future, and customers can trust the company, and it won't wind up or anything. So customers are like deeply attached to the company. So that's a good business model, I'd say.
okay, so here is like in the report we have attached the references and as well, and this is a chart of how the IPO journey begins and is able to reach the listing, and how a certain company can perform post IPO. Sir, this was our Review 3 presentation. We thank you for your guidance throughout the semester. And after this presentation, we have attached our report in the video as well. Thank you.